You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, well, last week we looked at a FOMO trade in Walmart, and that Walmart hasn't announced earnings, so I think that we should revisit that trade. They will be announcing earnings next week. And then we're also going to look at Home Depot. Home Depot is going to be announcing earnings, and we're going to take a little bit of a different twist on the Home Depot earnings than we did on the Walmart earnings. So as far as Walmart is concerned, I kind of mentioned on the show that maybe it might be a little bit early to do the trade. Well, overall, that was wrong in that Walmart is actually going in the right direction for the trade that we were putting on. Usually, if you're going to do a trade based off of earnings, though, you would do it a day or the day of, a day before or maybe the day of. But if we look at Walmart, they're going to be announcing earnings before the open on the 18th. So that's next week on Tuesday. And the trade that we looked at last week, we actually called it a FOMO trade. I said that this is a very popular strategy that's really never been named. And I really like to use it around earnings. That's when it's kind of interesting to me on an underlying that I wouldn't mind buying. So if we received, got a downturn after earnings, doesn't necessarily mean that it was good news or bad news, right? Sometimes stocks will go down even after good earnings. But if you are interested in buying that underlying stock on a downturn, this is an interesting way to do it as earnings are approaching. So instead of just going out and buying Walmart, buying that 100 shares that you wanted to buy, last week it was trading at 129.81, basically called it 130. If it's 130, you're going to be paying $13,000 just to buy the 100 shares of Walmart at 130. So what we did instead was, well, this earnings kind of makes me a little bit nervous. So we said, we'll sell a put if earnings are bad and the market goes down, or even if they're good and the market goes down in this frothy marketplace, that can happen. We'll sell the 124 strike put that expires after earnings. That would be August 21st expiration. And then we'll use the proceeds from selling that put to buy a long spread. Just in case earnings are good, let's have some benefit to the upside. So instead of just receiving the net credit and using that to lower our cost basis if the market goes down, we're going to protect ourselves also if the markets go up. And that's where the FOMO part of the title from last week's show comes from, fear of missing out. So what has happened in Walmart over this week is the stock has actually gone up. So if we look at Walmart right now, we're taping Options Playbook Radio. It is Wednesday, the 12th. The markets are closed. Walmart closed today up 169. It's trading at 131.89. That was the last trade in Walmart. And that entire spread now, if you were to set it up as we did last week, sell the put, buy the call, sell the 134 strike call or the higher strike call, all the option contracts with the August 21st expiration, that is trading now for a net debit of $1. So when we were looking at the trade last week, it was trading for even or basically zero. So you are up $1 on the trade. You could leave the short put out there. So I think it's worth mentioning that right now that short put still has about, I'm going to go at a midpoint here, about 80 cents left in it, which is okay. We wanted to buy it. You could obviously close out the whole trade, try to bring in $1, or you can go out and just close the long spread, close the 130 strike call and the 134 strike call. So what we'd be doing there is selling to close the 130, buying to close the 134, and in that instance, that's trading for about $1.75 just overall. So you have a little bit of a profit. Why would you take the risk of the earnings report on the call side? I mean, the stock has made a pretty good move up. We looked at it last week. It was 129.80. Now it's 131.89. It's up a couple of bucks. Long spread is worth something. So that's just an interesting thought. The way that I would approach it here is I might close out the long spread and stay short the put, still hoping that I get an opportunity to buy Walmart at a little bit lower price. Okay. So that was the summary from last week and a very quick overview. And the main reason why I'm talking about it is the earnings has not happened yet. We'll see what happens on Tuesday, the 18th, and see what they're going to be announcing before the open. Right now, that's an anticipated earnings date. It can always change, so we always have to say anticipated. And as always on Options Playbook Radio, nothing's meant to be a recommendation. We're just doing these trades on paper and we're trying to learn. So with that said, we're still, like I mentioned, I mentioned this last week, but a lot of the bigger companies in the S&P 500 index have announced already their earnings for the quarter. We still have a few stragglers left and a couple of stocks that have done well since the pandemic. And I actually mentioned a couple of these stocks last week, Home Depot and Lowe's. They're going to be announcing this week. We have Home Depot. They're going to be announcing before the open on the 18th. And then also we have Lowe's that is going to be announcing before the open on the 19th. So now Home Depot has become a little bit frothy. It's had a really good run up since the March lows, since the pandemic started overall. And what we're going to look to do this week, it's still an earnings play, just an interesting way to look at underlying stocks that you might actually want to be a little bit more bullish on going into earnings. And what way can how can I get into a long call position at a decent price? So that's our goal here. We're trying to be able to buy a long call position going into earnings for a decent price. Now, that's a little tough to do because usually around earnings, what happens to implied volatilities? They start to skyrocket. And that's going to be the case here with Home Depot. And not to mention the fact Home Depot is also a fairly expensive underlying. Home Depot closed today at $281.58. It's actually up $6.66 on the day. So $281.58, up $6.66. And so it's a little bit expensive stock, and that's going to add premium. And then we also look at the implied volatility. That's bumped up a little bit. It's trading right now at about 35% implied volatility, which is much lower than the March highs as far as implied volatility were concerned when the market was tanking. So 35% is a little bit higher than normal. But if we look at the expiration before the August 14th expiration that does not contain earnings, we see a 24% implied volatility. So the trade that we're going to look at today is actually going to be a diagonal spread. It's where we're going to go out and we're going to sell an option contract that expires before earnings. It's going to be at the lower implied volatility, but we're kind of hoping that we're getting a little bit of bang for our buck here. There's only 2 days left until that expiration. So you got all day Thursday, all day Friday, And we're kind of hoping that that option contract will expire and we'll be able to collect some of that premium that will lower the price of the long option contract that we really would like to own. But the problem with owning long options, especially out of the money options, which we're going to be buying here, is that they get a little bit expensive because implied volatilities get jacked up going into earnings because of that pending news. So with that said, let's get to the trade. All right, so our paper trade for this week, which is once again not meant to be a recommendation, we're going to be looking at Home Depot. Home Depot closed today on August 12th at $281.58. It's up $6.66 on the day. We're going to sell to open the August 14th expiration, 285 call, and then buy the August 21st expiration, 287.50 call. Right now, that entire gaggle of options is trading for a mid price of $2.90. That's the mid price. So we'd hope we could fill somewhere near that. The markets are closed. Just keep that in mind. But $2.90 or $290 plus commission. And that would be our total risk on this trade. Now, if we do this trade, we're specifically selling an out-of-the-money option contract, the 285 strike call, because we really don't want to be assigned on that short option. We want the stock. The most ideal scenario would be it's at, let's call it 281 and a half. It's 281.50. If the most ideal situation would be is that if that stock just creeped slowly towards 285 over the next day. Tomorrow it opened at 283, then it went to 284, and then expired just before it got to 285, right? That would be the most ideal scenario because then our short-term option contract would expire worthless. We would be able to keep that premium, and hopefully that premium will help us enough on our 287.50 strike call that expires after earnings to help us deal with that implied volatility crunch. And that's the whole goal of this trade. Now, with that said, we have some risk if we first put on this trade. First of all, we have a lot of risk to the downside. So if the market goes down, the 285 call will help us. It's going to bring in, if I look at the midpoint, once again, at where it's trading, right now, currently that August 285 call is trading right at the midpoint around 80 cents. So we have 80 cents of protection on our long call option, because that's our focal point here. If the market does go down, we can think to ourselves, well, okay, at least we have this 80 cents, and then that 285 should expire worthless. And now we're still long that 287.50 call. Now, here's the risk, though, that a lot of people have to consider is that we are still getting a lot of juice for these options, mainly because it's an expensive underlying, but also implied volatilities are a little bit inflated across the markets. Overall, it's selling a 25% implied volatility on that first expiration or that front month expiration or front week, I guess would be a better way to say it. And in that instance, I also want to pay attention to the delta of the option contract. The 285 strike call with the August 14 expiration right now has a delta of about 26. And I am hoping that my longer term option, which is usually the case, you go further out in time, and we can usually go further out of the money and still get a really good delta. So in this instance, our longer term option, the 287.50 strike, has a 36 delta. So this does mean that we do have some additional risk because we're buying the further out of the money strike option contract. So our net debit of 290 is not the total risk here. We also have a credit spread that's basically embedded inside this diagonal, if you will, and it is from 285 to 287.50. So there's another additional $2.50 worth of risk. So I want to make sure that if that market does come up and it starts looking like it might go above 285 before the near-term expiration date, I want to make sure that the deltas are saying I should still have a profit. Because if it gets up to 285 and all of a sudden it breaks through that and it's at 286, I just want to get out of this trade. I don't want to have that risk of that short-term options delta exploding and actually becoming larger than my longer term option. So I specifically set it up so my long-term option would have a higher delta to start with. I'm going to keep an eye on it. Definitely want to get an alert if this underlying gets to 285 over the next 2 trading days. And if it does, well, then I shouldn't have a profit. There's nothing wrong with this, but I'll probably just close out the trade before we get into the earnings. And I'll take the small profit as opposed to having that risk of that stock going hard and getting up to the 287.50 strike. And I actually lose something on a trade that was just meant kind of a generic trade that just is trying to get me a cheaper long option contract. So if the short-term option contract does expire, then I'm long the 287.50 call. And I just want to make sure that the underlying market thinks that it can get to 287.50. How do I do that? Well, if I look at that August 21st expiration, I just want to look at the most at-the-money long straddle. And right now, the 282.50 with the stock at 281.58, so it's the most at-the-money option contract, is trading for, let's call it $13. So the market says that the expected move or the potential move after earnings going all the way out to that August 21st expiration is $13. Now, that has no regard to direction, could be up or down, but that's kind of a line in the sand that the market has drawn by pricing the long straddle where it's at. So the 287.50 call is definitely within play with the market at 282.50. So it's a fairly decent out-of-the-money option contract. We got to pay some premium for it. We're trying to reduce it by selling a shorter term option contract. And this is definitely a speculative play. It's all about earnings, but it's a diagonal spread where we are selling a near term lower strike call option and buying a further out higher strike call option, anticipating that the short term option will expire worthless going into this expiration. Well, that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy@invest.ally.com. Also, follow me on Twitter using the handle Brian Overby. Thanks for listening. We'll be back the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.